It's another buying opportunity because the governments of the world are going to respond to that with massive currency creation. They'll be doing quantitative easing up to levels that we've never seen before. They'll be creating as much new currency as they feel like it takes to prevent that global margin call from turning into another depression. So at that point, gold and silver will just go straight back up again. The prize remains the same out there of, $15,000 gold and $200 silver. That's out there. That will happen at some point.
The global financial system is rapidly hurtling toward a massive economic correction as unsustainable sovereign debt mountains continue to grow exponentially. A sharp contraction across leveraged markets will likely trigger a severe global margin call, forcing widespread asset liquidations. John Rubino, a prominent financial author, emphasizes that this initial market crash will ultimately present the ultimate buying opportunity for precious metals. He predicts that the governments of the world will inevitably respond to this deflationary threat with unprecedented quantitative easing, creating massive amounts of new currency at levels never seen before to prevent another depression. Consequently, he forecasts that gold will skyrocket straight back up to $15,000 per ounce, while silver will surge to $200 per ounce in a powerful V-shaped recovery. Investors who maintain strong hands through the upcoming brutal liquidation stand to reap historic profits as fiat currencies rapidly lose their remaining purchasing power against real assets. Now, we present the clips from John Rubino's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Gold had a phenomenal run, so did silver, and they had the inevitable correction and then a consolidation, which is what we're in right now. So the question is that the end? Is the recent peak to almost $6,000 gold, is that the end of this cycle? And will we have another, generation of declining gold and silver prices until something else happens? Or is this just a correction in a bull market that has a lot further to run? And I would argue for the latter, because the underlying fundamentals that drove the last few years gold and silver bull market, they're still in place. Governments are still borrowing insane amounts of money on top of the insane amounts of money that they borrowed previously. Interest rates are at kind of normal levels, which means the interest cost on government debt mountains is growing exponentially. And as long as those fundamentals are in place, then there will still be capital flows out of financial assets and into real assets. So gold and silver have a lot further to run, as long as, the U.S. is running deficits of 6% of GDP and the overall debt is 120% of GDP. That's death spiral territory there. And we're not doing anything to get out of it. The U.S. isn't cutting its deficit in any way. And most of Europe is not either. We're all in a demographic place where boomers are retiring and we have to pay off all the promises that we made to my generation. And that's going to be incredibly expensive. It's going to lead to massive deficits going forward. And, all the ills that flow from that are still going to be with us in the future. So, gold and silver are still screaming buys at this point. If interest rates are rising because people are worried about inflation and they're requiring higher interest rates in order to make them want to lend depreciating currency, and get it back at some indeterminate time in the future, that's good for gold and silver because that means we're losing faith in the currencies. If interest rates reach a point where it's, the cost of money is so exorbitant that it's looking like it's going to cause a financial crisis that is deflationary, then that's not good for gold and silver. So, for instance, in the 1970s, which was really the biggest currency crisis before what we're going through now, interest rates and gold went up in tandem because they were going up for the same reason. Interest rates went up because people were worried about the dollar. Gold went up because people were worried about the dollar. So it's completely possible for higher interest rates to coincide with rising gold and silver prices. And I suspect that's what happens this time around too for a while. But we got to keep an eye on that because if interest rates spike And it looks like that's going to be debilitating for the housing market and for the auto market and for basically any kind of leveraged speculation. Then we're in 1930s deflationary crash territory, and we have to be very careful about what we own. But we're not there yet. That's a talk for a different time or future time.
Yeah, do you think we are seeing the early stages of a global return to viewing gold and silver as money rather than just commodities?
Oh, absolutely. And you can tell that that's true by what the central banks of the world were doing. Central banks, after being net sellers of gold for a couple of decades there, are now net buyers in a very big way. I mean, they're taking a lot of gold off the market. And they're not very price sensitive. They're buying it because they have a target in terms of tons that they want to own, because they have some plans for that gold. Either it's just to replace dollars in their foreign exchange reserves, or it's to fully back their currencies at some point in the future. And as long as that's happening, that's a huge tailwind for gold and to an extent for silver. And there's no sign that that's stopping, because it looks like a lot of the central banks still have higher targets in terms of how much gold they want to own. And they're methodically chasing that target by buying so much each month, and no, there's no end in sight for that process. When you get into financial trouble, whether you're an individual or a government or a corporation or whatever, and you are facing some version of a margin call, something wants a lot of money from you, and a lot of your assets are falling in value, then you tend to sell the thing that's still holding up, right? And that could be something that affects the gold market going forward. If a lot of the world, not just governments, but everybody else, faces some kind of a global margin call, they're going to have to sell whatever they can sell to pay off that margin call. And that might hit gold and silver very hard. If it happens, then it's another buying opportunity, because the governments of the world are going to respond to that with massive currency creation. They'll be doing quantitative easing up to levels that we've never seen before. They'll be creating as much new currency as they feel like it takes to prevent that global margin call from turning into another depression. So at that point, gold and silver will just go straight back up again. It'll be a V bottom. And so we suffer through the downward part of that, and then we profit massively if we're gold bugs when it goes back up again. So we've seen that happen a few times, 2008, 2020, when there's some kind of a crisis, gold and silver tank along with everything else. But then they turn around and just head north again. So that's a possible scenario. And it's the kind of thing you need to be prepared for if you are in precious metals for the long haul. That is, until we have a currency reset. So yeah, there can be brutal corrections along the way. And, people having to sell their gold to get out from under a margin call could be the cause of some of those corrections. But we just have to know that the prize remains the same out there of, $15,000 gold and $200 silver. That's out there. That will happen at some point. And in the meantime, if you want to be there when it happens, you have to suffer through corrections and just be strong hands. Don't be the weak hands that are chased out of markets because of corrections.
The historical experiment with fiat currencies is approaching its inevitable conclusion because unlimited government credit cards inherently destabilize the financial architecture. As inflation forces interest rates higher, the rising cost of servicing massive public debt will become entirely debilitating for major nations. Central banks are already methodically purchasing massive volumes of physical gold to prepare for an unavoidable monetary transition. This looming systemic reset will require a severe devaluation of paper currencies before linking them to a hard gold standard. Consequently, the general population storing wealth in traditional bank accounts or government bonds will face severe impoverishment, while tangible asset holders will be massively enriched. This dramatic wealth redistribution is predicted to ignite widespread civil unrest across multiple countries. A major banking crisis will manifest simultaneously as dollar-denominated debt assets on institutional balance sheets lose value, leaving a commodity-backed system as the only viable option. Now, let's get back to the interview.
But fiat currencies turned out to be a flawed concept. They just don't work. and they were okay for a little while, and then the problems have gotten more and more serious because they're basically an unlimited credit card for governments, and they lead governments to do things that no normal government would be expected to do. We've piled up insane amounts of debt. That debt is now costing governments as interest rates go up in response to the inflation, which is inevitable when you create this much currency. The interest cost on our debt is becoming debilitating. And that means one way or another, the fiat currency experiment has to end. So money will always be around. And the question is, what kind of money, what form of money do we replace the current dollar, euro, and yen with? And that's a very interesting story, because it could be a lot of different things. Probably it will be a gold standard of some sort because that's familiar and we know how it works. And central banks are accumulating lots of gold, which means they're kind of looking at the possibility of backing their currencies with gold. And, it's a question of timing more than if it's going to happen. A gold standard, if say you back your currency with gold, the currency's still there. It's still in people's pockets. It's still in people's paychecks, and nothing changes. So it's just, instead of a fiat currency that's not backed by anything, you're transacting and saving in a currency that is backed by something. So it's a much better currency. Now, the problem is the transition from here to there, because the people who trust the governments of the world, in other words, people who have government bond funds that depend for their value on the value of the currency and who store lots of dollars in bank accounts, they will tend to be hurt by a transition to a gold standard, because basically what you're doing is devaluing your currency before you link it to something like gold. And so the people who are holding the currency, they're impoverished. And the people who are holding the gold, they're enriched. So to go from here to some kind of gold standard, you've got to get past the inevitable civil unrest that's going to flow from the government impoverishing half the population and enriching the other half. We're already doing that now with tech stocks and things like that, but we'll be doing it with the actual money when the time comes. That's still the least painful option, because the other options are hyperinflation or 1930s style deflationary depression. Nobody wants to go through something like that. And we will go to commodity-backed money when that is the least bad option that governments have. And so, again, it's a question of timing. We don't know when that will be, but it's coming soon.
That implies certain reset in the system. I think you would agree. Will that include more of a chaotic period involving banking problems, shortages, and social instability? Do you think that will happen in this transition?
Well, I think the transition could happen because of a lot of crises, like you just mentioned. We'll hit the point where there's a crisis that the governments cannot bail everyone out of because it would take too much money, and that causes the currency to fall in a disorderly way, and then you get the currency reset. But while you're doing a currency reset, you have lots of potential for turmoil too. The banks could have trouble when, because their asset is dollar-related debt, right? So if dollar-related debt, in other words, the assets on banks' balance sheets, become a lot less valuable, then maybe you do have a banking crisis. So, it's not painless. And it's not easy, but it's probably the only option that is feasible at some point. So yeah, we would have a lot of crises. You could easily justify shorting the banking system, in other words, bank stocks, in anticipation of something like this, because the banks will probably be hurt by it, as will maybe the home builders and the insurance companies. Everybody who owns or trades in dollar-denominated debt will be at risk in a currency reset. If you look at a chart of the dollar's purchasing power, it's been going down, 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 down ever since the 1970s. So, just looking at that chart, you would say we're in a collapse already, that the value of fiat currencies are falling at an accelerating rate. So, that the final tip off the cliff, the step that takes you straight down hasn't happened yet, is, I got to say, surprising. I expected it to happen a lot sooner than this because the numbers were already unmanageable. when the tech stock bubble burst in 2000. A currency crisis, by definition, means people lose faith in a currency. And they don't want to hold it anymore because they don't trust it to hold its purchasing power. So they convert it into real stuff as soon as they get paid or whatever. And that means the price of real assets tends to go up because more capital is flowing into them. And the price of things like government bonds and bank accounts that depend on the value of the currency, they go down in value. So you get this massive change in capital flows out of financial stuff into real stuff. And that causes the value of the currencies to go down. And then governments have to, they'll panic and they'll figure out or try to figure out what to do about protecting their currencies. And at the end of this process will come a time where that doesn't work, where governments just cannot protect the value of their currencies because nobody wants to hold them anymore. And there's a term for that. It's called the crack-up boom in the Austrian School of Economics. And how it could happen in today's world is we could have another big crisis. Maybe the AI bubble bursts, or there's another war, or there's some kind of energy crisis. Lots of things could happen. But one of those things happens, and the governments of the world and the central banks of the world step in to bail everybody out, and nobody trusts them. So the bailout fails. And at that point, we figure out, okay, there's no adult supervision in the financial world right now. Let us bail. And everybody runs for the exits. And your currency just collapses in value and has to be replaced with something. So that's kind of, in very broad terms, that's how it will play out. But there will be specific crises and specific policies. And a lot of them will be familiar. We won't know what the governments of the world choose, but they'll choose from the list of things that have worked in the past. But this time they won't work.
A profound shift in international capital allocation is quietly accelerating as global investors lose faith in the purchasing power of traditional paper money. When the public finally realizes that fiat currencies are depreciating at an uncontrollable pace, a sudden exodus from financial instruments into real assets will occur worldwide. This terminal phase of monetary decay, known in economic circles as a crack-up boom, will cause the velocity of money to spike dramatically as citizens desperately attempt to exchange cash for tangible goods before it loses all value. The spark for this systemic collapse will likely be a specific modern crisis, such as the abrupt bursting of the over-leveraged artificial intelligence bubble, an escalating geopolitical conflict, or an acute international energy shortage. When central banks try to deploy their standard playbook of injecting trillions in emergency liquidity to protect the markets, the public will completely reject the intervention, causing the bailouts to fail entirely. This sudden, absolute loss of institutional supervision will trigger a chaotic and disorderly downward plunge for the dollar and euro as trust completely vanishes from the financial markets. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.